one thing that you mentioned that I'm sure the listeners are like, what is, you said you bought your first 3-unit apartment complex, multifamily, when you're a sophomore in college. So if you can just take us back to those days, how did you get the knowledge, the courage, the connections to actually go ahead and do that while being a sophomore in college? What were you, 19 years old?
So I was 20. I think I was 20 or 21 when I bought that. It was my junior year in college.
Okay.
But I mean, I started learning about real estate probably a year before that. I mean, if not even more than that. So that's how I start. Anytime I'm ever asked that question, that's how I started. I'm like, well, it was 12 months of just education where I was listening to podcasts and just reading articles and reading books like literally every day. Um, and what I quickly realized was, hey, I don't have the money to go out and buy one. So, traditional financing is simply not an option for me. So I just never even spent any time trying to figure that out. So for me, it was like the only way I can ever buy something is if I have a private lender on it. And I was fortunate enough to have an internship at the time where I was working at an angel group. So it was like 10 guys that were meeting every month and listening to startup pitches. And basically my job was just scheduling the meetings, taking notes, doing some of the admin work and getting paid, $10 an hour to do it. But was around a bunch of guys that were extremely successful in whatever they were doing. So one of the guys happened to be, he owned a massive portfolio of real estate amongst other businesses and did a lot of private money lending. So he was the one that really introduced me to the idea of going out there and borrowing money from an individual to go buy property. And I had read about it, but I didn't understand how it was actually put into action. So basically bent his ear for, once a month, when the meetings were once a month, I talked to him once a month and built a relationship with him over many month period of time. And basically said, hey, if I can find a deal that looks like this, basically created a sample deal that said, if, this is the price, if it's, a light rehab and this is kind of the rehab and, this is how much money I can bring to the table. This is something that you'd want to lend on. And he was like, yeah, that makes sense. And basically what I did was figured out who was going to be the lender and what I could actually buy and then reverse engineered into what I should actually go out there and look for in terms of a deal. So that first deal I found on Craigslist. It was a for sale by owner and it was just discounted and it didn't really need that much work. It was just, seller who didn't really want to work with an agent and got it below market. And that was just kind of how I did the first one. And I still brought money to the deal. I mean, I brought like 15 grand to the deal, which was every single dime I had really at that point. So it wasn't like I was getting in with $0, and I think that's kind of a misconception is people are like, you can get into it with no money. Well, you need some money. Even if you're getting 100% loan to value, you still need money for the closing costs and to put into the property and to just have in reserve so that you don't get screwed if the water heater breaks right when you close. So I still had some money and I put a good amount of money into it, but it was a really, really low risk deal for the lender. There was income in place. It wasn't that big of a project in terms of the renovation requirements. So it was a really easy one to get into.
Gotcha. Okay. And you mentioned he was a lender. And so for this property, it didn't need a lot of rehab. It was just a little bit more turnkey, it sounds like. So what was the strategy for this and how did that align with the lender? Was it a long-term hold? Did you try to refinance him out? What was kind of the play?
Yeah. So this is where I should have figured out what the strategy would be a little bit more thoroughly when I bought it. So I had a 12-month private mortgage on it, 10% interest, 1 point in terms of when I paid it off, I had to pay a point of the loan. So I wasn't like I'm getting drilled with hard money rates, but pretty normal private money rates. So what ended up happening was my plan was I'm going to go buy this. It's already below market value. I'm going to go raise the rents a little bit. I know what the comps are, and then I'm just going to go refinance with a bank. And quickly realized that no, I couldn't get any financing from a bank. So I was 21 at the time or something like that, and had no job, no W-2, awful tax returns, no income. So a 30-year fixed rate mortgage, I wasn't even close to qualifying for that. So then I worked backwards into, well, maybe like a local bank or a local community bank can put a commercial loan on this, which is, how I financed everything since this deal. But even then, as a borrower, still didn't have enough to show them that, that I made sense to even lend money to. And even though they still underwrite based on property first and, borrower kind of second, they still look at the borrower. And if the borrower has nothing on their tax returns, you're probably gonna be hard to get a loan. So quickly realized I couldn't even go out there and refinance. And then if I did, it would have to be, 70% loan to value or some low figure where I would have to go bring a bunch of money to even close it. So long story short, I just decided to sell that one. and I didn't even sell it for what I thought I could sell it for. So a bunch went wrong in that first one. Namely, the septic tank was way too small for the property, and since I bought it with a private money loan, I didn't have the traditional underwriting that a bank does, kind of helping me out and looking at, kind of watching my back and correcting any mistakes. So when I went to put it on the market, it wouldn't qualify for FHA or VA or USDA or any conventional financing program because the septic tank was too small and the well itself was too close to the septic tank. So I had to sell it to a cash buyer, and ended up, it's not like I lost money, but I didn't really make much. So it was just great to get the reps in, needless to say, to close something. And I had bought a couple of deals since that first one. And kind of going full cycle on one and making a little bit. And at that time I was also getting a job, and that's what made it easier to refinance those other ones ultimately.
Gotcha. Okay, cool. And you mentioned at the end of this, you were in the process of getting a job. What was that job? Was that the realtor?
Yeah, so I say job, it was mainly me just going out there and actually closing deals on the agent side and putting some money
Gotcha.
kind of in the bank, which again isn't great for lending in terms of it's a 1099 and they consider you
Right.
self-employed, but it's something, right? That isn't nothing.
Yeah, 100%. So what was the next step in your journey? Because you've built up a huge portfolio since then. You sold this one. Where did you go after you became a realtor, put some money in your pocket? What was next as far as building your portfolio?
Yeah, so I became really hyper focused on finding good deals because I realized that the only way that I could continue building a portfolio is if I really was mindful of the whole velocity of money concept, right? Where you got to get in at below market value so that you're not leaving a lot of money in these deals when you go and refinance. So, I had a little nest egg after I sold that first one, and I was working, and I was living pretty cheap in terms of where I was living, so I was saving a good amount of money, and I was like, I just need to stretch this as far as I possibly can. So I just went out there and started finding really good deals where when I refied, I was leaving no money in the deal or even getting paid. So started doing a couple of those a year. The first year, maybe I did like 6 or 8 units or something. Second year, maybe did 15, 20 units. And I was also selling some along the way. It wasn't just only buying. And I think that's like a misconception, is like, you can't just buy. Even if you're finding really good deals, you can't only be buying, right? Sometimes you have to sell to recapitalize, and you got to roll that money into, maybe bigger deals. So, maybe I bought a duplex that I refinanced all my money out of. It kind of went up in value. I got a really good offer, sold that one, and bought a 4 unit or a 6 unit with those proceeds. So I started doing that over the next 2-3 years, and eventually built it to like a 25, 30 unit portfolio. And at that point I was like, I'm not going to spend any time working with clients on the agent or broker side. And I wasn't even making that much money doing that anyways. It was mainly just paying my bills, since I already knew that wasn't what I enjoyed doing. But I basically said, I'm going to, just completely stop trying to do that. And I'm going to go all in on trying to find deals and building the portfolio. So from there, I started flipping a few that I found, some of the smaller ones, and holding on to the larger ones. And again, just continued rolling it into a bigger and bigger portfolio.
Thanks for watching that clip from the Real Estate Investing Made Simple podcast. If you want to see the entire interview, go ahead and click the link in the description below. And don't forget to subscribe to stay tuned for all future episodes.